Beyond Meat Inc. is trading at 78 cents right now on the Nasdaq, up 0.69% in today's session as of 12:03 p.m. ET on Friday, January 30th, 2026. While that tiny green flicker might look like a relief to some, the reality under the surface is far more complicated than a simple intraday bounce. Most people looking at their Robinhood app or checking their individual brokerage account see a stock that has been absolutely gutted, trading nearly 90% below its 52-week high of $7.69. The expectation among the general public is that this is a slow-motion car crash, a company that was once the darling of the plant-based world, now fighting for its life as a penny stock. But here is the part the market isn't talking about yet. Beyond Meat is currently attempting a massive structural pivot that moves them away from just being a fake meat company and into the wellness beverage space with the launch of Beyond Immerse. This isn't just a new product, it's an attempt to fix a broken business model by entering a higher margin category. Whether that actually works is the billion-dollar question that is currently keeping institutional investors on the sidelines. When you look at the landscape of online investing right now, there is a massive gap between the narrative and the numbers. The narrative is that everyone has moved on from plant-based meat. The reality is that while the hype has died, the infrastructure Beyond Meat built remains. However, that infrastructure is expensive. The company is burning through cash at a rate that has many analysts on sites like Seeking Alpha and various investing sites questioning if they can even make it to the end of the year without another massive capital raise. If you're looking for investment help on a stock like this, you have to realize that you aren't just betting on a burger, you're betting on a balance sheet reorganization. Most people using self-investing tools see the sub-$1 price and think it's a bargain, but when you look at the $1.2 billion in debt, the math gets very scary very fast. Comment below how many shares of Beyond Meat stock you currently hold, or if you've already moved your capital into safer plays like Apple stock or Nvidia stock. The trading volume today has been relatively steady, but it lacks the conviction of institutional buyers. When you see big players through Fidelity Wealth Management or Schwab Intelligent Portfolios, they aren't looking at BYND as a core holding. They are looking at the risk of delisting. Because the price is sitting below that $1 threshold, the clock is ticking. If they can't get this back up, they'll be forced into a reverse stock split just to keep their spot on the Nasdaq. This creates a high-tension environment for anyone using the Robinhood app for Robinhood investments or Robinhood stock trading. You're essentially playing a game of chicken with the exchange. Meanwhile, competitors are closing in. While Tesla stock and Nvidia stock represent the high-tech growth side of the market, Beyond Meat represents the broken growth story. The company is trying to right-size, which is a polite way of saying they are cutting costs to the bone because the revenue just isn't there. Let's talk about the actual business for a second. Beyond Meat rose to fame by promising a product that looked, cooked, and tasted like beef. For a while, it worked. They got into every major grocery store and secured partnerships with fast food giants. But the reality of the consumer market eventually caught up. The products were expensive, and as inflation hit, people went back to cheaper proteins. Now, the company is reporting revenue declines of nearly 15% year over year. They are losing money on almost every pound of product they sell once you factor in the overhead. This is why you see such a disparity in online investment advice. Some see a turnaround play, others see a terminal decline. If you're using a SoFi Robo-Advisor or SoFi Active Investing, your portfolio might be steered away from high volatility names like this because the downside isn't just a price drop, it's a total loss of equity if they hit a liquidity crunch. Institutional activity has been telling. We've seen some insiders selling small chunks of shares recently, which never looks good when the price is at all-time lows. When you use professional tools like the Interactive Brokers platform or Interactive Brokers stock trading, you can see the depth of the order book, and it's clear that there's a lot of resistance every time the stock tries to move toward the 90-cent mark. There is a wall of sellers who are just looking for any exit liquidity they can find. This is the reality that is currently crushing the expectation of a meme stock-style rally. While we saw a brief spike in late 2025 where the stock jumped on social media hype, it couldn't hold those gains because the fundamentals didn't back it up. If you're doing your own investment research through Fidelity IRAs or Fidelity Brokerage, you have to look at the upcoming earnings report on March 3rd. That is going to be the make-or-break moment for 2026. Management has promised that they will reach a positive EBITDA run rate by the second half of this year. That is a massive mountain to climb. To do that, they have to not only sell more of their new protein drinks, but also drastically increase the margins on their core meat products. The problem is they are trapped. If they raise prices, they lose customers to cheaper competitors. If they lower prices to gain market share, they lose even more money. It's a classic corporate trap. The broader market isn't helping much either. While some tech names like Nvidia stock have been propping up the indexes, the consumer staples and alternative protein sectors have been lagging. Investors who use intelligent portfolio tools or explore different investing sites are starting to realize that the first mover advantage Beyond Meat had is now a first mover burden. They have the oldest factories and the highest debt loads compared to some of the leaner startups. This is why the sentiment on the SoFi trading platform and Robinhood app has shifted from the future of food to can they pay their bills? When we look at the macro picture, interest rates are still high enough that refinancing that $1.2 billion in debt is going to be incredibly painful. If you are managing your own Fidelity ETFs or looking for investment help through Fidelity Investments, you'll notice that the high-yield debt market is being very cautious with companies like Beyond Meat. This affects the stock price because if the bondholders think they own the company, the stockholders are the ones who get wiped out. This is the tension between the growth story people want to believe in and the debt story that actually exists. So, what is the actual outlook here? If Beyond Immerse, their new drink line, takes off, they might find a new life as a lifestyle brand. There is a real trend toward clean protein and functional beverages. If they can capture even 5% of that market, the revenue could stabilize. But that requires a lot of marketing spend, which a company with no cash can't easily do. It's a bit of a catch-22. On the other hand, there is always the possibility of an acquisition. A larger food conglomerate like Tyson or General Mills might want the Beyond brand name, even if they don't want the current debt. But an acquisition at these levels would likely be a fire sale, meaning current shareholders wouldn't see the massive payday they might have hoped for back in 2021. Looking at the charts on the Interactive Brokers trading tools, the moving averages are all trending downward. There is no clear support level until we get much closer to the 52-week low of $0.50. This is a falling knife scenario. For those using Robinhood Crypto or other speculative tools, the temptation to buy the dip is strong, but in this case, the dip just keeps dipping. The reality is that the company is currently valued more like a distressed asset than a growth company. The market cap has shriveled to under $350 million, which is a fraction of what it once was. In the final analysis, Beyond Meat is a masterclass in the psychology of expectation versus reality. The expectation was a world where plant-based meat replaced the traditional cattle industry. The reality is a niche product with high production costs and a consumer base that is very price-sensitive. As you navigate your online investing journey, whether through SoFi Stocks, Fidelity mobile app, or Interactive Brokers account, you have to decide if you're betting on the brand or the business. The brand is still strong. People know what a Beyond Burger is. The business, however, is currently broken. To summarize the situation, we are looking at a stock that is technically in a death spiral, but trying to pull out of it with a total product pivot. The intraday movement of 0.69% to $0.78 is a drop in the bucket compared to the historical losses. The institutional sentiment is overwhelmingly sell or underweight, and the retail sentiment is divided between hope and total fatigue. The path to 2026 for Beyond Meat is narrow, steep and full of obstacles. Unless they can show a dramatic improvement in gross margins or a miracle with their new beverage line, the reality of their debt load is likely to remain the dominant force in the stock price action. We've gone from a company that was expected to change the world to a company that just needs to change its bank balance. It's a sobering reminder for anyone in the self-investing world. A great product doesn't always make a great stock. Keep a very close eye on that March earnings date, as that will be the moment the market decides if the current $0.78 is a floor or just a temporary stop on the way down. Would you like me to analyze a different ticker, perhaps one of the tech leaders like NVIDIA, or a more stable value play? Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.